This AI-generated podcast is for general information only and does not constitute financial or legal advice. Please consult a qualified professional. Welcome to the Luxembourg Fundcast. Produced by Bertrand Mariaux, a regulatory lawyer qualified as Avocat à la Cour in Luxembourg and Paris, this show brings you reliable insights on Luxembourg regulations sourced from curated official references. This episode is current as of 4 April 2026.
It is really excellent to be here to explore these highly important developments today.
Yeah, I'm looking forward to it. So imagine looking at your firm's operational dashboard on the morning of, say, 17 April 2026.
Right.
You log into the CSSF eDesk portal, and you see that your liquidity management frameworks, your third-party delegation controls, and your digital operational resilience reporting.
That they are all perfectly synchronized across every single product in your portfolio.
Exactly. There are no contradictions between what your risk management team has filed and, what your valuation team executes.
I'd say it's the ideal state.
It is. And today we're discussing exactly how to build that reality for your platform. So welcome, everyone. Our focus today is to thoroughly unpack the CSSF's 2026 priorities for supervising the investment fund sector.
Yes.
We're specifically detailing how you can align your operations with this highly sophisticated integrated framework.
And that's exactly what it is. The CSSF's supervisory priorities represent a highly constructive, really refined approach to financial stability and investor protection.
Right.
They're providing the market with a very clear operational standard, one that, supports Luxembourg's exceptionally robust fund sector.
It's a system that really rewards clarity, doesn't it?
Oh, absolutely. It rewards clarity, structural consistency, and a highly professional operational posture.
Well, let's get straight to the practical reality of this. We're moving away from treating these topics as high-level abstract theories.
Yeah, we are focusing purely on execution today.
Exactly. So if you are managing a platform right now, what is the absolute overarching theme of these 2026 priorities? I mean, how should you conceptualize this shift in supervisory expectation?
Well, the central theme is that the CSSF is presenting a fundamentally risk-based, integrated supervisory agenda.
Integrated, that's the key word there.
Right. To understand the operational impact, you sort of have to look at how firms have traditionally structured themselves.
Okay, walk us through that.
Well, in the past, you might see areas like governance, third-party risk, digital operational resilience, liquidity, and valuation. You'd see those treated as separate departments.
Yeah, totally isolated.
Right. A manager might have had a risk team calculating liquidity profiles on one floor and an entirely separate IT department managing digital resilience on another floor.
And they probably rarely spoke to each other.
Exactly. But what the CSSF is communicating through these priorities is that these functional areas are no longer separate conversations. They all sit within one completely joined-up supervisory framework now.
Let me push back on that slightly, purely from an operational standpoint. I mean, I completely understand the CSSF's goal of integration.
Sure.
And it is a really constructive structural move for the jurisdiction. But practically speaking, if I'm a manager with 50 different funds, forcing my DORA compliance personnel to sync perfectly with my liquidity risk team, well, that sounds incredibly resource intensive.
I can see why it would seem that way.
Right. So how is a firm supposed to actually achieve that operational unity without, completely rebuilding its infrastructure?
Well, that is the precise operational challenge. And really, it's why the CSSF is communicating these priorities so clearly right now.
So they aren't expecting a total rebuild?
No, they're not asking you to rebuild your infrastructure overnight. What they are asking you is to ensure that the data flowing through your existing infrastructure is consistent.
Ah, okay. The flow of data.
Right. For example, if your digital operational resilience framework identifies a critical vulnerability in a third-party data provider,
which falls under DORA.
Exactly. Well, your valuation team needs to know about it immediately because it directly impacts their ability to price the fund's assets accurately.
That makes perfect sense.
The CSSF is looking for the structural pathways that allow that information to flow smoothly.
So it is about data transmission within the firm. It's about ensuring the left hand not only knows what the right hand is doing, but that they are, reading from the exact same operational manual.
Yes, that is a very precise way to put it.
Well, moving from that overarching philosophy to the immediate realities, let's look at the practical must-knows. And the first one is an immediate date on your calendar.
Yes. The nearest hard deadline we have from the official materials is 16 April 2026.
16 April 2026. Let's walk through the precise mechanics of that date. What actually happens on the eDesk portal?
Well, by this date, undertakings for collective investment in transferable securities.
Commonly known as UCIs.
Right, UCI-80, or where applicable, they're management companies. And also authorized alternative investment fund managers managing open-ended funds.
Okay, so those specific managers, what do they need to be ready to do?
They have a very specific reporting obligation. They must communicate their liquidity management tool selection to the CSSF.
And this has to be done in a specific way, right?
Yes. This communication must be executed precisely through the dedicated eDesk procedure.
Let's break that mechanism down further, because it's not just a general email to the regulator saying, we have a liquidity policy.
Oh, no, not at all.
What is the actual data point they are capturing there?
The CSSF requires a precise notification regarding the selection of specific liquidity management tools, or LMTs, for open-ended funds.
Okay.
And the dedicated eDesk procedure for these tools actually comprises two distinct modules.
Two modules. What's the first one?
The selection module, which was actually launched earlier on 23 March 2026. The initial communication regarding your selection is due by 16 April 2026.
Got it. And the second module?
Concurrently, the activation module launches on that exact same date, 16 April 2026.
Right. This means that by 16 April, the CSSF wants a clear, platform-wide map of exactly which liquidity tools you have assigned to which open-ended products.
Precise.
Which feeds directly into that integrated supervisory review you mentioned earlier.
Exactly. It provides the CSSF with a highly structured data set on how these specific fund structures are positioned to manage their liquidity risk profiles in practice.
So it's not just theory, it's practical data.
Yes, it is a vital component of proactive financial stability.
Which brings us perfectly to our second practical must-know, which I think we can call the integrated core.
I like that term.
Because when you review the official materials, the focus extends far beyond just liquidity management.
Oh, significantly beyond it, yes.
There is a very explicit inclusion of digital resilience and third-party oversight within the main supervisory agenda.
And what is particularly notable here is how the CSSF has expressly embedded these elements into their mainstream supervisory work. Implementation of DORR, the Digital Operational Resilience Act, along with information and communication technology incident reporting, and third-party risk governance.
They are all included.
Yes, they are no longer peripheral technical issues. They are core components of the day-to-day supervision of investment fund managers.
Let's unpack the mechanics of that integration. Because when you say mainstream supervisory work, how does an ICT incident under the DORR framework actually trigger a broader supervisory review?
Yeah, that's the crucial question.
What is the actual mechanism there?
Well, the official texts provide specific references for this operational reality. The materials explicitly reference Circular CSSF 25893, which governs ICT incident reporting.
Okay, so that's the specific circular.
Yes. And under this integrated approach, if a manager reports a major ICT-related incident, the CSSF does not merely view it as an isolated technological failure.
They look at the bigger picture.
They assess how that incident impacts the firm's overall governance. They look at its ability to execute its valuation policies and its capacity to manage third-party delegations.
So the technological risk is immediately translated into a broader operational and financial risk context.
Exactly.
That makes the stakes entirely clear. It is not just the IT department's problem anymore. It is fundamentally a board-level governance issue.
Absolutely.
And this mainstreaming extends to third-party providers as well, correct?
It does, yes. The official materials note that this integrated approach includes a sample-based study on third-party risk and delegation controls.
And that study is scheduled for 2026.
That's correct. Scheduled for 2026. This demonstrates that your oversight of external service providers is fundamentally intertwined with your overall risk framework.
The regulator isn't just taking your word for it.
No, the CSSF is actively testing the strength of those connections.
Okay, so if we consolidate the takeaways thus far, we've got a lot of ground covered. You have a highly integrated supervisory philosophy.
Yes.
An immediate deadline of 16 April 2026 for notifying your liquidity management tool selection.
Crucial date.
And a clear, functional embedding of digital resilience and delegation controls into the core supervisory framework.
That sums up the high-level takeaways perfectly.
Well, to fully grasp how you should execute on these takeaways, we need to look at the structural parameters.
I agree.
We need to detail exactly who falls under this emphasis, what the actual requirements are, and how this entire framework operates in practice.
Breaking this down into its specific structural components is really the most effective way to map out the required operational response.
Let's run a thorough briefing on this core change. We will start with the who.
Okay.
If you're listening to this, you need to know exactly where you stand. So who, precisely, falls under this supervisory emphasis within the Luxembourg ecosystem?
The official material is very clear on the jurisdictional perimeter here.
Who is included?
The priorities are relevant for investment fund managers, specialized investment funds, investment companies in risk capital, UCIs, and Part 2 UCIs.
Wow, so that represents a very broad scope of the Luxembourg market.
It effectively encompasses both the retail and alternative spaces, yes.
Right. But within that broad group, does the text highlight any specific operational profiles that will see particular supervisory emphasis?
Yes, it does. While the scope is broad, the supervisory emphasis is particularly visible for 3 specific product and operational profiles.
Okay, what is the first one?
First, investment fund managers operating open-ended funds and semi-liquid private asset strategies.
Open-ended and semi-liquid. What's the second profile?
Second, funds with material private debt exposure or funds with higher leverage.
Private debt and higher leverage. And the third?
And third, managers that heavily utilize third-party providers in ways that require robust oversight and delegation controls.
Let's pause on that specific taxonomy for a moment, because I think it reveals a great deal about the CSSF's logic.
It absolutely does.
You have open-ended and semi-liquid strategies, private debt and leverage, and high reliance on third-party delegation. Why these 3 specific profiles?
It's quite logical when you look at it structurally.
What is the structural rationale for focusing supervisory resources exactly there?
Well, it is a highly rational clinical approach to systemic stability. Let's take them sequentially.
Okay, let's start with the open-ended and semi-liquid strategies.
Those strategies require precise alignment between the liquidity of the underlying assets and the redemption terms offered to investors.
Because if there's a mismatch there, things can go wrong quickly.
Exactly. Ensuring that alignment is functioning perfectly is a core tenet of investor protection.
That makes sense. What about the second group, private debt and higher leverage funds?
Those involve complex credit risk management and intricate valuation processes. The inherent risk profile is simply higher.
Right. Complex valuations need close monitoring. And the third group?
Finally, heavy reliance on third-party delegation introduces deep operational dependencies.
So if a provider goes down?
Exactly. If a critical service provider fails, the manager must have the structural resilience to maintain operations without interruption.
So the CSSS is focusing precisely on the operational areas where structural complexity is highest.
Yes, that is the exact rationale.
That clarifies the who perfectly. It is a purely risk-based mapping of the sector.
It is.
So let's examine the whats. I want to ensure you have total clarity on the exact nature of this supervisory development.
This is a very important distinction to make.
Right, because this is not a brand new piece of primary legislation being introduced, is it?
No, it is not. The core change is not a single new law. Rather, it is a clearly articulated supervisory agenda for 2026.
So how should a professional define the exact nature of this agenda? I mean, if the CSSF is not handing down a new law, what exactly are they assessing against?
In highly practical terms, the CSSF is signaling that managers must be able to evidence a coherent, fully functional control environment.
A coherent control environment.
Yes, and this environment must span across internal governance, compliance, internal audit, risk management, third-party oversight, DORA implementation.
It covers a lot.
It does. It also covers liquidity and credit processes, valuation, sustainability arrangements, fee discipline, and anti-money laundering, terrorist financing, and proliferation financing controls.
That extensive list really illustrates the integrated nature of the agenda we discussed earlier.
Yes, it shows how wide the net of integration really is.
It is asking you to demonstrate that the entire operational machine works together seamlessly. And there are specific mechanisms planned to verify this integration, correct?
Yes, there are. The CSSF states that in 2026, it will launch a targeted study among a sample of investment fund managers.
And what exactly will this sample-based study assess?
It will assess compliance with 2 very specific sets of principles regarding external dependencies.
Okay, let's get into the specifics. What is the first set?
First, the European Securities and Markets Authority's 14 Principles on Third-Party Risks Supervision.
And those were published recently, right?
Yes, they were published on 12 June 2025.
Okay, so the ESMA 14 principles. What is the second set of principles?
And second, the delegation-related principles found under Circular CSSF 1698.
Let's explore the intersection of those 2 frameworks. ESMA's 14 principles and Circular CSSF 19698. How do they actually dovetail in practice?
Well, Circular CSSF 19698 is a cornerstone document for Luxembourg investment fund managers.
It's been around for a while.
Yes, outlining detailed requirements for authorization, organization, and substance. It establishes the baseline for how a manager must govern delegation.
Right, that's the local foundation.
Yeah.
And the ESMA principles.
The ESMA 14 Principles on Third-Party Risk Supervision from June 2025 provide a highly specific, updated framework.
Updated specifically for what?
For assessing how managers oversee those external dependencies, particularly in light of increasing technological integration.
So it ties back to the IT and DORA aspects.
Exactly. The CSSF's 2026 study will evaluate how effectively managers have integrated these ESMA principles into their existing 18698 governance structures.
So they are looking for active integration.
Yes, it is a test of ongoing active oversight, rather than just passive contractual compliance.
This raises an important point about the geographical and chronological architecture of these priorities. The action is clearly based here in Luxembourg, driven by the CSSF, but the operational architecture seems much broader.
You're right, the implementation is indeed Luxembourg-based, but the architecture is plainly European and global in its alignment.
The CSSF does not operate in a vacuum.
No, they don't. They expressly align their 2026 priorities with ESMA's Union Strategic Supervisory priorities.
And globally as well.
Yes, and with the International Organization of Securities Commission's 2026 work program, they are also explicitly building upon European legislative instruments such as DORA.
So the Luxembourg framework is perfectly harmonized with the highest levels of European and global supervisory strategy.
That is exactly the design.
This ensures that a Luxembourg platform is operating at the forefront of international standards. Well, let's plot out the chronological timeline based purely on the official references.
Timelines are critical here.
When did all of this begin to unfold, and what are the specific milestones you need to track?
The timeline is highly structured. The CSSF formally published these priorities on 31 March 2026.
Okay, 31 March 2026 was the publication.
Right. And if we look back at the dedicated eDesk procedure for liquidity management tools, the selection module was officially launched on 23 March 2026.
And then we have that critical April deadline.
Yes, the initial communication regarding that selection is due by the critical date of 16 April 2026. And as we established, the activation module for those tools launches on that same date, 16 April 2026.
And looking slightly further out on the official calendar, are there other scheduled supervisory actions you need to prepare for?
Yes, the CSSF explicitly states that in the second half of 2026, it will carry out a common supervisory action focusing specifically on the risk management function.
We'll touch more on that common supervisory action later, but just to ensure the timeline context is complete.
Yes, we must note that at the European level, DORA has been applicable since 17 January 2025.
Okay, so DORA is already in play. That provides a very solid, objective map of the timeline. Now let's delve into the why.
The underlying rationale.
Exactly. Why is the CSSF constructing this deeply integrated, highly detailed framework right now? Is this purely an administrative exercise of checking compliance boxes?
No, it is far more fundamental than an administrative exercise. It is fundamentally structural.
Structural in a way.
The CSSF's stated policy objective rests on two primary pillars. First, proactive financial stability, and second, robust investor protection.
Proactive stability and investor protection.
Furthermore, they are taking careful account of the broader economic and geopolitical context.
How does geopolitics factor into this specific operational framework?
The official materials explicitly state that specific risk surveillance for geopolitical risks and their impact on the investment fund sector will continue.
That points to a highly proactive regulatory stance. It is about building deep structural resilience into the system so that the Luxembourg funds sector remains a safe, highly stable environment regardless of broader global market volatility.
That is the ultimate goal.
Financial stability and investor protection are not merely theoretical concepts here. They are the functional operational goals of every single requirement we are discussing today.
Exactly. Every operational element, from testing your valuation models to verifying your delegation contracts to reporting a major ICT incident.
It's all connected.
Yes, it is a specific mechanism designed to uphold and reinforce those two pillars.
Which naturally leads us to the critical question of execution. The how.
The most important part for practitioners.
Right. If you are listening to this and you understand the integrated agenda, the precise timeline, and the structural rationale, the next logical question is, how does your firm actually demonstrate this integrated compliance to the CSSF?
How do you prove it?
Yes. How do you prove that your operations meet this standard?
Well, the official texts indicate that demonstrating compliance will be assessed across 3 practical, distinct operational layers.
3 layers. This is the structural blueprint for how a manager builds and evidences their control environment.
Correct.
Let's walk through those 3 layers sequentially. What is the first layer you need to examine?
The first layer is the manager-level framework.
Manager level, what does that entail?
At this foundational level, an entity must demonstrate sound governance, highly effective internal control functions, and a risk management framework that is operationally credible and fully resourced.
So it's about the overarching structural integrity of the management company itself.
Yes, ensuring the board has comprehensive visibility over the entire operation.
Understood. A solid, integrated foundation at the management company level. So what constitutes the second operational layer?
The second layer moves down to the specific product-level framework.
Product level.
Here, the supervisory focus is on the operational reality of the specific funds being managed.
What specifically do they look for at the product level?
The framework must conclusively demonstrate that controls regarding liquidity, credit, leverage, valuation, sustainability, and costs actually function properly in practice for each specific product profile.
Not just on paper, but in practice.
Exactly.
So layer 1 is the overarching corporate governance. Layer 2 is the specific operational mechanics of each fund structure. And the third layer?
The third layer focuses on the mechanics of communication and control, specifically escalation and reporting mechanics.
Escalation and reporting.
A manager must be able to prove that these mechanisms function properly and promptly when required by operational realities.
Can you walk us through the specific examples of these reporting mechanics mentioned in the official materials? How do they manifest in daily operations?
Certainly. The most immediate example is the liquidity management tool notifications through the eDesk portal that we discussed earlier.
The ones due by 16 April.
Yes. A second critical example is the mandatory reporting of major ICT-related incidents under Circular CSS A25893.
Under the DORA umbrella.
Correct. And a third example involves the systematic monitoring and reporting of net asset value errors and investment rule breaches.
And that falls under a specific circular as well.
Yes, under Circular CSSF 24856.
Let's pause on that third example, Circular CSSF 24856 regarding NAV errors, because I think that perfectly illustrates the mechanism of escalation.
It's a great case study for this.
How does that circular function within this integrated environment?
Well, Circular CSSF 24856 provides a highly structured objective framework. It determines when an NAV calculation error or an investment breach is deemed material.
Right.
And it sets out the precise steps a manager must take to report it to the CSSF and remediate the issue for investors.
So how does integration change that process?
In an integrated supervisory environment, the NAV error is not just a math problem for the fund administrator anymore.
The CSSF looks deeper.
They will look at how that error occurred. Was it a failure of third-party oversight? Was it a breakdown in the valuation policy? Was it exacerbated by an ICT system failure?
So the root cause might be in a completely different department.
Exactly. The escalation mechanism must capture the root cause and inform the broader governance framework.
That is a very comprehensive breakdown of the 3 layers: manager-level governance, product-level controls, and functional reporting and escalation mechanics.
Yes, those are the 3 key pillars of execution.
When you map it out clinically like that, it becomes entirely clear that these 3 layers require a very specific, coordinated operational response from your management team.
You certainly cannot simply rely on legacy templates or disconnected departmental reporting.
No, that won't work anymore. This leads us directly into the execution playbook.
Absolutely. A structural understanding of the rules must immediately translate into coherent operational realities on the ground.
So let's move to that operational reality. If you are a manager sitting at your desk today, looking at your entire platform of funds,
right,
what is the immediate physical task you should undertake to begin aligning with these priorities?
The immediate operational task, advised by a careful reading of the official materials, is a highly controlled review of your entire fund population.
A controlled review? But how should that be structured?
The crucial operational point here is that this review must be conducted strictly by risk profile, not merely by legal label.
Let's clarify that distinction, as it is central to the execution strategy.
It is fundamentally important.
What does reviewing by risk profile versus legal label mean in practical terms for, say, a compliance officer or a conducting officer?
Well, it means you do not simply group all your UCITs in one compliance silo and all your alternative investment funds in another.
Which is how a lot of firms historically did it.
Yes. But instead, you look at the underlying operational realities and asset classes.
So you look at what the fund actually does.
Exactly. You systematically identify the open-ended funds, the semi-liquid private asset strategies, the products with material private debt exposure.
Right. You categorize them by their actual market behavior.
You also identify the higher leverage products, the products with extensive third-party operational dependencies, and the sustainability-labeled products.
And why is that risk-based grouping superior?
Because under this highly integrated framework, these specific risk profiles sit much more visibly inside the supervisory map. It doesn't matter whether the fund is structured as a UCITS or an AIF. The functional risk is what matters.
That makes perfect sense. The functional risk profile dictates the required supervisory and operational scrutiny.
Precisely.
So once you have accurately mapped your fund population by risk, what is the correct sequence for the documentation review? Which specific files need to be examined?
In practice, this requires a sequential, thoroughly interconnected review of specific document sets.
Interconnected, so you can't just review them one by one in isolation.
No, a manager must critically review their liquidity management tool policies, their delegation and outsourcing framework files, and their valuation policies.
Altogether.
Simultaneously, yes. They need to review their DORA incident reporting procedures, their board reporting materials, their sustainability support files, and their fund error remediation frameworks.
And the key to this playbook is that you have to review these documents in tandem, correct?
It is absolutely essential.
Because you cannot simply update the valuation policy in isolation, send it to the board for approval, and consider the job done.
Precisely. And that brings us to what the official text identifies as the fundamental operational necessity at the heart of this entire agenda.
Which is
the crucial role of consistency.
Let's bring this down to a practical reality. Think of an integrated corporate database.
Okay.
You cannot have the human resources department inputting one employee identification number, the payroll department operating off a completely different identification number, and the IT access control system relying on a third disconnected set of data.
No, that system would crash immediately.
Right. Every department must pull from and contribute to the exact same synchronized data set, or the entire corporate structure fails to operate effectively.
That is an excellent practical analogy, and it perfectly mirrors the CSSF's structural expectations for fund managers.
How does the official material emphasize this?
The official material emphasizes that a fund cannot present one liquidity narrative in its legal prospectus, a second, slightly different narrative in its internal risk management models.
And a third one somewhere else.
Exactly, and a third, entirely separate narrative in its actual day-to-day valuation practice.
So the narrative has to be identical across the board.
The operational narrative must be perfectly uniform across all layers of the firm.
It is fundamentally about structural integrity and data consistency.
Yes.
And this strict requirement for consistency applies heavily to how external service provider relationships are managed as well, does it not?
Oh, absolutely. The supervisory materials are exceedingly clear that a manager must not present third-party oversight as merely a formal contractual matter.
Meaning you can't just sign an agreement and forget about it.
You cannot simply execute a service-level agreement, place it in a compliance file, and claim that your oversight obligations are fulfilled.
What does the supervisor expect to see instead?
The supervisory emphasis is plainly focused on ongoing active control. They want to see the deep integration of that third party's operational data into the broader risk framework of the manager.
So if we look at the core difference, it is the distinction between having a static legal document that claims you are compliant versus having a dynamic, living operational process that consistently proves you are compliant in real time.
Exactly. It is the fundamental difference between formal, paper-based compliance and highly credible operational execution.
Credible operational execution.
And this critical distinction is a direct inference from the integrated supervisory themes expressly identified by the CSSF in their 2026 priorities.
That standard credible operational execution is what every management company board should be aiming for.
Without a doubt.
Now, anytime we discuss regulatory refinements and structural operational changes, The question of financial impact inevitably arises for market participants.
Naturally, cost is always a consideration.
Looking closely at the official materials, what is the clear update on costs, regulatory fees, or potential tax impacts resulting directly from these priorities?
Well, relying strictly and exclusively on the official materials reviewed for this analysis, the answer is highly objective.
What do the texts say?
The materials do not specify any new sector-wide CSSF fee tied to the implementation of these 2026 priorities.
Okay, so no new fees are explicitly mentioned.
Furthermore, they do not identify any standard external pricing benchmarks or announce any direct tax framework changes linked to this specific supervisory agenda.
Thank you for providing that objective clarity. The focus, therefore, remains entirely on operational alignment, governance precision, and control frameworks without any newly announced direct financial levies in these specific publications.
That is correct, based on the official texts.
We have now covered the internal operational reality comprehensively, the strategic playbook, the absolute need for documentation consistency, and the risk profile mapping.
Yes.
Now let's pivot from the internal firm environment to the external macro environment. Let's examine how this highly structured operational playbook fits into the current, broader market landscape in Luxembourg.
This contextual analysis is vital.
Why is that context so important?
The market context determines how these supervisory expectations interact with the realities of scale and growth.
Let's take the pulse of the market. What do the official CSSF figures tell us about the current size, scale, and trajectory of the Luxembourg market as we contextualize these 2026 priorities?
The official statistical figures paint a picture of an exceptionally robust and rapidly expanding market.
Can you share the specific numbers?
The CSSF reported that as of 28 February 2026, Luxembourg undertakings for collective investment held a total of 6,436.135 billion euros in net assets.
6,436.135 billion euros. That is a truly extraordinary figure.
It is massive.
And it underscores the immense systemic importance of the Luxembourg jurisdiction on the global stage. What is the current trajectory of that growth?
The growth trajectory remains highly positive. That total asset figure represents a 2.25% increase over just a single month.
Over 2% in 1 month.
Yes. And if we look at the data over a 12-month period, it represents an 8.04% increase.
That's very strong, consistent growth.
Furthermore, the CSSF noted positive monthly net capital investment inflows and positive market valuation effects.
So what does this specific market context mean for you as a professional operating in this space? If we connect these data points, we see a highly constructive intersection.
Yes, the timing is key.
Supervisory expectations regarding operational integration, digital resilience, and third-party oversight are becoming markedly more precise exactly at the same time that the Luxembourg Fund platform continues to expand its asset base rapidly. We are not looking at a regulatory framework designed to restrain a market. We're looking at a sophisticated supervisory architecture designed to actively support and secure a very large, growing global ecosystem.
That is the most crucial contextual insight.
The synergy between growth and supervision.
Yes. This combination, a very large, rapidly growing asset base, coupled with a highly integrated, sophisticated supervisory approach, it underscores exactly why credible execution is so vital.
It makes it a necessity, not an option.
It explains with complete clarity why structural document alignment and perfect board-level traceability are more important than ever.
Because the stakes are higher with more volume.
Exactly. The supervisory goal is to sustain this immense market scale securely, ensuring that the core pillars of financial stability and investor protection remain absolute constants, even as the volume of complex assets continues to increase.
It is a profoundly constructive operational environment. The market is thriving, and the regulator is providing the clear framework necessary to ensure the foundations remain exceptionally solid.
That's a great summary of the dynamic.
Having established both the internal operational demands and the external market context, let's move smoothly into future operational planning.
The look ahead.
Yes, let's look ahead, basing our analysis strictly and exclusively on the official calendar.
Yes, and it is highly important we remain entirely objective and structurally focused here.
Absolutely. We will explicitly stick only to confirmed official dates provided in the texts. We are not in the business of speculation.
Agreed.
So, what is the concrete verifiable calendar provided in the materials?
The nearest fixed verified milestone, which we must continually reiterate for operational planning, is 16 April 2026.
We've mentioned it, but let's reinforce why this date is critical.
It marks the absolute deadline for the initial liquidity management tool selection communication through the eDesk portal.
Right.
Crucially, it also marks the official launch date for the liquidity management tool activation module.
So 16 April 2026 is the immediate operational focus. What is the next express supervisory milestone officially identified on the calendar?
The next dated supervisory milestone expressly identified by the CSSF is the Common Supervisory Action, or CSA.
The CSA. What is its focus?
It focuses specifically on the risk management function, and it is formally scheduled for the second half of 2026.
Let's elaborate briefly on the mechanics of a common supervisory action for context. How does a CSA functionally operate within the European framework?
A common supervisory action is an initiative coordinated by ESA, where national competent authorities, like the CSSF in Luxembourg, simultaneously assess a specific regulatory topic across their respective jurisdictions.
And they use a common methodology for that.
Yes, a common methodology. The goal is to ensure consistent application of European rules.
So for the second half of 2026, the CSSF will be looking deeply at how risk management functions are operating in practice, aligning their findings with the broader European supervisory perspective.
Exactly. It is another clear example of the integrated, harmonized architecture we discussed.
That provides excellent context for what the second half of the year will look like operationally.
And what about the other major themes mentioned in the priorities?
Such as?
Topics such as sustainable finance, complex valuation, and anti-money laundering controls.
For the thematic supervisory work on semi-liquid funds, private debt structures, complex valuation processes, sustainable finance, costs and fees, and anti-money laundering controls, the CSSF absolutely confirms these are central, ongoing themes of their supervisory focus.
Are there specific dates for those?
However, they do not assign fixed public dates for specific actions on these topics within the priorities paper.
Okay, so the dates are pending.
The specific dates for targeted actions in these areas are to be confirmed.
I think it is also critical to firmly underline how the framework views certain operational areas, particularly anti-money laundering and terrorist financing controls.
Most definitely. Controls relating to anti-money laundering, terrorist financing, and proliferation financing are not passing supervisory trends or temporary areas of focus.
They are permanent. They are permanent structural pillars of the Luxembourg regulatory framework.
So how do they fit into the 2026 agenda?
The integrated agenda we are discussing today simply ensures that these AML and CFT controls are communicating effectively with all other risk and governance areas within a firm.
That is an excellent point of clarity. Knowing the confirmed dates, the permanent structural pillars, and the broader market context leads us to the final and arguably most crucial step of our deep dive.
Yes, putting it all into practice.
We need to put all of this together into a cohesive, functional strategy. We need to look at a comprehensive execution scenario demonstrating absolute mastery of the CSSF's priorities.
This is exactly where regulatory theory translates into credible, demonstrable, and highly effective compliance on the ground.
So let's set up a highly practical, realistic scenario for you, the listener.
Let's do it.
Imagine you are the conducting officer of an investment fund manager based here in Luxembourg. You are handling a complex, mixed platform.
A very common scenario.
You manage a range of alternative investment funds, including some semi-liquid strategies and private debt vehicles, and you also manage several traditional UCIs.
Okay, a diverse mix.
Given everything we have discussed regarding integrated supervision, DORA implementation, third-party risk principles, and strict liquidity management protocols, what exactly is your operational strategy right now?
Well, the mastery approach to this scenario is highly methodical and entirely clinical.
It has to be structured carefully.
Yes. As we noted during the playbook discussion, the sensible first step is not a rushed blanket rewrite of every single policy document in your firm.
Why not just rewrite everything to be safe?
That is an inefficient approach that often introduces new contradictions. The correct professional approach is a carefully controlled perimeter exercise.
A controlled perimeter exercise.
Right.
Walk us through the exact sequential execution steps of that exercise for this specific mixed platform scenario. What is step one?
Step one involves precisely mapping the risk profile of your entire platform, exactly as the priority suggests.
Okay, the risk mapping.
You must systematically identify all the open-ended and semi-liquid products currently operating.
And what else do you isolate?
Simultaneously, you must isolate and categorize any products with material private debt exposure or higher leverage characteristics.
So you know exactly where your complex risks are.
Yes. By doing this, you are firmly defining the perimeter of where your highest integrated operational risks lie.
That structural mapping brings immediate operational clarity. Once the perimeter is defined, what is step 2?
Step 2 zeroes in on the immediate practical regulatory requirements.
So getting ready for the deadlines.
For the relevant funds you successfully identified in Step 1, you must confirm precisely which liquidity management tools have been formally selected by the board.
And that's to prepare for the April 16th deadline.
Furthermore, you must verify exactly how the activation and deactivation of those specific tools are governed, documented, and tested in practice.
It's not just the selection, but the mechanics of activation.
Right. This strict verification ensures you are fully prepared for the eDesk modules mandated for 16 April.
Excellent. And step 3, which is the most comprehensive phase of the strategy.
Step 3 is the deep integration phase. This is where you actively test your operational assumptions against the integrated framework.
What does that testing look like?
You must verify whether your complex valuation assumptions genuinely align with your actual liquidity realities on the ground.
Ensuring the models match reality.
Then you systematically bring your governance models, your third-party oversight mechanics under the ESMA principles, your DORA implementation protocol.
All of those disparate elements.
Yes, your incident reporting procedures, your sustainable finance support files, and your comprehensive board record framework into a single unified operational file.
Let's pause and examine that concept. A unified operational file. That sounds incredibly powerful from a governance perspective.
It is the ultimate goal of this framework.
What is the resulting posture for a management company that successfully executes this 3-step mastery approach and builds that unified file?
The operational result is transformative. It creates a pristine, highly coherent supervisory record and a remarkably clear decision trail for the board of directors.
So everything is traceable.
Exactly. If the CSSF later reviews the structure, perhaps during the common supervisory action in the second half of the year, the manager presents a highly credible professional execution posture.
There are no gaps in the story.
There are absolutely no contradictions between what the legal prospectus states, what the risk management team models, and what the valuation team executes.
Because it all comes from the same source.
Everything flows from a single verified source of operational truth.
It is the ultimate practical demonstration of that credible execution we defined earlier. It is an elegant, highly professional response to a sophisticated, integrated supervisory agenda.
The reasonable analytical conclusion is that Luxembourg is strategically important for this theme because the same jurisdiction often concentrates the manager, the fund, the governance chain, the service provider network, and the cross-border distribution logic, so supervisory expectations can translate quickly into platform-wide operational consequences.
That is a phenomenal, highly precise synthesis of why this jurisdiction's operational mechanics are so unique, and exactly why this integrated supervisory approach is so vital for maintaining its premier status. We have covered an immense amount of ground today, from the overarching philosophy of structural financial stability to the precise reporting mechanics of the eDesk modules and the absolute necessity of building a unified operational file. As we wrap up this deep dive, I want to offer you a final thought to consider for your own operations. We have talked extensively about alignment, mapping risk profiles, and meeting the CSSF's sophisticated expectations. But consider this from a purely strategic perspective. How might this process of building a unified operational file, this rigorous process of forcing your legal documentation, your risk management teams, and your valuation processes to tell the exact same, consistent, verified story? How might that not just satisfy a supervisory expectation, but actually streamline and clarify your own internal board decisions? What if this process of integrated compliance, driven by the CSSF's constructive framework, is actually the ultimate operational tool for turning regulatory adherence into a strategic competitive advantage for your platform? Think about the sheer operational clarity that brings to your leadership team. Follow on Apple Podcasts, Spotify, or wherever you get your podcasts. Subscribe to Bertrand Mariaux and Rigor Media on YouTube. Connect with Bertrand on LinkedIn at bertrandmariaux.com, all links in the show notes. This was the Luxembourg Fundcast.